Stop what you're doing. Look at your screen. Read this number carefully, because what I'm about to show you isn't speculation. It isn't theory. It isn't coming. It's here, right now, today, January 9th, 2026. The COMEX registered silver inventory has been drained by 70% since 2020. 70%. From 346 million ounces down to approximately 82 million ounces. But that number you see today, it's even worse. Because in December alone, over 60% of remaining registered inventory was claimed for delivery in just 4 trading days. 4 days. That's 47.6 million ounces evacuated from the system in less than a week. London LBMA vaults hold 27,818 tons of silver as of the end of December. That sounds like a lot until you understand the context. That's down from a peak of over 34,000 tons in early 2021, a 40% decline in less than 4 years. And here's what nobody's telling you. 75% of that London inventory is locked up in ETFs, theoretically unavailable. Of the remaining 25%, only a fraction qualifies as actual free float, accessible silver that can be sold into the market. Shanghai Gold Exchange inventories just hit 623 tons. That's the lowest level since 2015, a decade low. Chinese warehouse stocks have collapsed so severely that in October, China exported over 660 tons of silver to London, the highest volume on record. They drained their own vaults to relieve a supply squeeze that was threatening to implode the entire Western paper market. But that relief was temporary, because by November, Shanghai inventories had fallen right back to decade lows. The metal that went to London isn't coming back, and Shanghai is once again running on fumes. At current industrial consumption rates, Western vaults contain between 30 and 45 days of accessible supply. Not months, days. If solar panel manufacturers, electric vehicle producers, electronics companies, and AI data centers continue demanding silver at the pace they're demanding it. Right now, the accessible silver in Western vaults will be gone by the end of Q1, maybe mid-Q2 at the latest. And here's the data point that proves the market is already breaking. Physical silver in Shanghai traded at $78.55 per ounce on December 24th. COMEX paper futures on that same day closed at $72.36. That's a premium of over $6 per ounce. But by late December, that premium had spiked to $8 per ounce. $8. Think about what that means. Physical silver, the real metal you can hold in your hand, is trading $8 higher than the paper contract. The market is telling you in the clearest possible language that paper promises and physical reality have diverged. The price on your screen, the COMEX spot price, is no longer the real price. It's a discount bin. A clearance sale on promises that may never be kept. This isn't theory. This is observable. This is happening right now. And what I'm about to show you in the next 15 minutes is the exact mechanism of how Western silver vaults are being drained in real time, why the 30 to 45 day countdown is not speculation but mathematical certainty, and what happens when industrial regions run out of deliverable metal while paper contracts still promise supply that does not exist. The vaults are empty. The countdown has begun, and the system is about to discover that you cannot deliver what you do not have. Let me show you exactly how this ends. Before we go deeper, you need to understand what registered inventory actually means, because the distinction between registered and eligible silver is the difference between what is available and what's just stored. COMEX vaults hold 2 categories. Eligible inventory is silver stored in COMEX-approved warehouses, but not available for delivery against futures contracts. The owners of that metal are using the warehouse as secure storage. They have no obligation to sell it. Registered inventory is silver that has been delivered onto the exchange and is available to fulfill futures contract obligations. It's the deliverable supply, the buffer that keeps the paper market functioning. In 2020, COMEX registered inventory stood at 346 million ounces. By late 2023, it had fallen to 82 million ounces. That's a 70% decline. But the drain didn't stop there. Throughout 2024 and into 2025, registered inventory continued falling. By September 2025, it was down to around 113 million ounces. And then December happened. In December 2025, the silver market experienced what analysts are calling an unprecedented physical drain. In just 4 trading days, 47.6 million ounces were claimed for delivery. That represents over 60% of the registered inventory that existed at that moment. 4 days. The velocity of that drain is what should terrify you, because it means the market participants who understand physical supply chains saw something coming and moved first. They evacuated their capital from paper promises into physical metal before the window closed. And here's what the COMEX did in response. On December 23rd, the CME Group issued Advisory 25393, raising margin requirements for silver futures to $25,000 per contract. $25,000. That's more than double the previous requirement. Why? Because the exchange recognized that the system was on the verge of collapse. They had to make it more expensive, more difficult, more painful to demand physical delivery. They had to slow the drain. But raising margin requirements doesn't create silver. It just delays the inevitable. It buys time. And the question is, time for what? Time to find more silver? Or time to prepare for default? Now let's talk about what happened to the metal that left the vaults. Some of it went to industrial users who need silver to manufacture products. Solar panel companies, electronics manufacturers, electric vehicle producers, they're the ultimate end users. Once silver enters industrial supply chains, it's gone. It gets embedded in products, shipped globally, consumed. It doesn't come back to the vaults, but a significant portion went east to China, to refiners and industrial buyers who saw the price divergence between COMEX and Shanghai and executed arbitrage. They bought cheap in New York, shipped it to Shanghai, sold it at a premium. Risk-free profit. Except it's not risk-free for the system, because every ounce that leaves the COMEX and arrives in Shanghai never comes back. China doesn't export refined silver to restock Western vaults. China consumes it domestically or locks it into long-term industrial supply chains. Now, look at London. The London Bullion Market Association reported 27,818 tons of silver in their vaults as of the end of December 2025. That's approximately 895 million ounces. Sounds massive compared to COMEX's 82 million, right? But here's the trap. 75% of London's silver, roughly 670 million ounces, is held in exchange-traded funds, ETFs, SLV, SIVR, other funds that theoretically allow investors to own silver without taking physical delivery. But those ounces are not available to the market. They're locked. If you're an industrial buyer who needs 10 million ounces delivered next month, you can't access ETF silver. It's spoken for. It belongs to fund shareholders who bought shares expecting the fund to hold metal. Of the remaining 25%, which is about 225 million ounces, only a fraction qualifies as free float. The rest is held by institutions, sovereign entities, private vaults that use London as a storage hub. They're not sellers, they're accumulators. According to some estimates, the actual free float in London, the silver that is genuinely available to satisfy immediate demand, might be as low as 50 to 100 million ounces. That's the liquidity, that's the cushion. And it's disappearing. Throughout 2025, London vaults experienced net outflows. Silver didn't flow in, it flowed out. In October, 660 tons, over 21 million ounces, left China destined for London. That arrival temporarily stabilized LBMA inventories. But by November and December, the outflows resumed, because the Shanghai premium persisted. As long as physical silver in Shanghai trades at $6, $7, $8 over COMEX, the arbitrage remains open. Metal will continue flowing east. And once it's gone, it doesn't return. Now let's shift to Shanghai. Because Shanghai isn't just another market. Shanghai is where the physical reality is set. The Shanghai Gold Exchange reported 623 tons of silver in inventory as of late November 2025. That is approximately 20 million ounces, the lowest level since 2015, a decade low. But the real story isn't the inventory number, it's the withdrawal rate. In October, 387 tons were withdrawn from Shanghai vaults in a single month. That's over 12 million ounces. At that withdrawal rate, the remaining 623 tons would be gone in less than 2 months. Chinese demand is insatiable for a reason. China produces 80% of the world's solar panels. Every panel requires silver paste for conductivity. China is the largest manufacturer of electronics globally. Every smartphone, every laptop, every data center server uses silver. China is scaling AI infrastructure. Every AI chip, every GPU cluster, every data processing facility demands silver components. And China is building electric vehicle supply chains domestically. EVs use 3 times more silver than traditional combustion vehicles. So when you see Shanghai inventories at decade lows, it's not because demand is weak, it's because demand is overwhelming supply. And here's the policy shift that locks this in permanently. On January 1st, 2026, China implemented new export restrictions on refined silver. Only large state-approved companies with annual production capacity of at least 80 tons can export silver, and only after obtaining special government licenses. This move effectively blocks hundreds of smaller exporters who used to supply Western markets. China controls between 60% and 70% of global refined silver supply, and as of 8 days ago, that supply is now ring-fenced for domestic use. This is the checkmate move, because even if Western mining companies increase primary silver production, most refined silver processing happens in China. You mine the ore in Mexico, Peru, or the United States, but you ship the concentrate to China for refining. And now China controls whether that refined metal comes back to the West or stays in China. And based on Shanghai inventory levels and Chinese industrial demand, it's staying in China. Let me show you the math on the 30 to 45-day supply estimate, because this isn't speculation, it's arithmetic. Global industrial demand for silver in 2025 was approximately 700 million ounces. That's solar, electronics, EVs, medical devices, 5G infrastructure, everything. Divide that by 365 days. Industrial demand consumes about 1.9 million ounces per day globally. Now let's focus on Western industrial regions, North America and Europe. Estimate that these regions account for 30% of global industrial demand. That's about 210 million ounces annually, or 575,000 ounces per day. Now look at accessible Western inventory. COMEX registered 82 million ounces, but falling rapidly. London Free Float, estimated at 50 to 100 million ounces. Total accessible, roughly 130 to 180 million ounces. Divide 130 million by 575,000 ounces per day. You get 226 days. But that assumes zero additional financial demand, zero hoarding, zero arbitrage flows to Shanghai. In reality, financial demand, arbitrage, and delivery requests are accelerating. So the drain rate isn't 575,000 ounces per day. It's closer to 1 million ounces per day or more. At 1 million ounces per day, 130 million ounces last 130 days, 4 months. But remember, December saw 47.6 million ounces claimed in 4 days. That's nearly 12 million ounces per day. If that pace continues, 130 million ounces disappear in 11 days. The range is somewhere between best case, 4 months if demand normalizes, and worst case, weeks if the panic accelerates. Split the difference. 30 to 45 days is the realistic window if current conditions persist. Now let's talk about backwardation. Because backwardation is the market's way of screaming that physical supply is critically tight. Normally, futures contracts trade at a premium to spot prices. This is called contango. It reflects the cost of storage, insurance, and financing over time. If silver costs $30 today, the 3-month futures contract might trade at $30 or $50. You're paying for the convenience of locking in future delivery. But when the market enters backwardation, that relationship inverts. Spot prices trade higher than futures. The 3-month contract might be 29.50 while spot is 30. This means the market is paying a premium to get silver now, immediately rather than waiting. Backwardation signals that holders of physical metal have more leverage than future speculators. It signals that immediate demand exceeds immediately available supply. Silver has been in backwardation for months. The spread between spot and futures reached 288 at one point in late 2025, the widest since the 1980s. The December futures contract traded below the spot price. The March contract traded even lower. This is the market telling you in mathematical language that metal now is more valuable than promises of metal later. And the reason is obvious, there might not be metal later. But here's where it gets even more extreme, the physical premium. We talked about Shanghai trading $8 over COMEX, but the backwardation isn't just in Shanghai, it's everywhere. Look at the exchange for physical spread, the EFP. This measures the premium physical holders' demand to deliver metal against futures contracts. The EFP spiked to nearly 1 per ounce in late 2025, a dollar premium just to convert a paper contract into physical delivery. That's insane. It's the market pricing in the risk that physical delivery might not be available at all. And if you can get metal, you'll pay extra for it. Now, think about what this means for the paper market. COMEX silver futures trade at around $72 per ounce as of early January 2026. But to actually get physical delivery, you're paying $73 for the EFP, plus potential storage fees, plus shipping. And if you want to sell that metal in Shanghai, you're receiving $78 to $80 per ounce. That's a $6 to $8 arbitrage. And as long as that arbitrage exists, metal will continue flowing east. The COMEX price is a fiction. It's the price of a promise. The Shanghai price is reality. It's the price of metal. And here's the terrifying part. What happens when COMEX can no longer deliver? What happens when the next batch of futures contracts mature and 50 million ounces are demanded for delivery, but only 30 million ounces remain in registered inventory? The exchange has 3 options. 1, scramble to source metal from eligible inventory, paying massive premiums to convince private holders to sell. 2, invoke force majeure, a fancy legal term for we can't deliver. Cash settle the contracts at the paper price and leave buyers without metal. 3, change the rules. Restrict delivery. Raise margin requirements further. Limit the number of contracts that can stand for delivery. All 3 options destroy confidence. Option 1 admits the paper price is wrong and forces a repricing. Option 2 admits the system is broken and physical supply is gone. Option 3 admits the exchange is rigging the market to protect itself. And once confidence breaks, the paper market collapses. Holders of futures contracts realize they're holding IOUs backed by nothing. They demand delivery while they still can. This accelerates the drain. More delivery requests, less inventory, higher premiums, more backwardation. It's a death spiral. And we're watching it happen in real time. Let's look at the industrial side, because industrial buyers are in a panic. Imagine you're the procurement officer for a major solar panel manufacturer. Your factory produces millions of dollars worth of panels every month. To produce those panels, you need silver paste. Silver represents maybe 5% to 10% of your total input costs. But without silver, you can't produce anything. Zero revenue. In a normal market, you order silver on a just-in-time basis. You don't hold massive stockpiles because that ties up capital. You order what you need for the next month or two and assume supply will always be available. But what happens when your silver supplier tells you delivery times just went from 2 weeks to 3 months? Or worse, we don't know when we can deliver? You panic. You start hoarding. You order 6 months of supply instead of 2 months. You pay premiums. You lock in long-term contracts at higher prices just to guarantee supply. And that panic is happening right now. Industrial buyers who operate on inelastic demand, meaning they'll pay almost any price to secure supply, are outbidding financial speculators. This is why Shanghai trades at a premium. Chinese industrial buyers need silver to keep factories running. They're not price sensitive, they're availability sensitive. When a factory manager in Jiangsu province needs 10 tons of silver to keep production lines operating, he's not waiting for the price to drop. He's buying at market. And if market means $80 per ounce, that's what he pays. This inelastic demand is a critical concept because it means price increases don't reduce demand. In normal commodities, higher prices destroy demand. Oil at $150 per barrel causes people to drive less, fly less, consume less. But silver in industrial applications can't be easily reduced. You can't build a solar panel with half the silver and expect it to work. You can't build an EV with 30% less silver and maintain performance. The silver is embedded in the technology. It's essential. So even as prices spike, industrial demand remains constant or grows. And here's the compounding problem. Industrial silver is gone forever. Once it's embedded in a solar panel installed on a rooftop in California, that silver is functionally destroyed. It's not coming back to the market. Recycling rates for silver in electronics are 18%. That means 82% of silver used in devices is never recovered. For solar panels, it's worse. Panels last 25 to 30 years. Even when they reach end of life, recycling is expensive and inefficient. Most panels end up in landfills. That silver is gone for decades. So every ounce consumed by industry today is an ounce that won't be available tomorrow. The above-ground stockpiles that once acted as a buffer that absorbed short-term supply shocks are being systematically depleted, and they're not being replaced. Because mining production is flat. According to the Silver Institute, annual mine production has been essentially stagnant since 2016. Some years up slightly, some years down slightly, but no major growth. And remember, 75% to 80% of silver production comes as a byproduct of copper, zinc, and lead mining. Silver isn't the primary target. It's what you get when you mine for other metals. This means silver supply is price inelastic on the production side. Higher silver prices don't automatically result in more silver production. If copper prices are weak, copper mines shut down. And when copper mines shut down, their byproduct, silver production, disappears. This structural constraint means supply can't respond quickly to demand spikes. Even if silver hits $100 per ounce, you can't just open new mines overnight. Mining projects take 5 to 10 years from discovery to production. Permitting, financing, construction, all of it takes time. And the silver that's needed today can't wait a decade. Now, let's address the question everyone's thinking. If the supply situation is this critical, why isn't the price spiking to $150, $200, $300 per ounce? Why is COMEX still quoting $72? The answer is the paper market, the futures market, the derivatives complex that sits on top of physical silver and controls the price discovery mechanism. The vast majority of silver trading happens in paper form. Futures contracts, options, ETFs, over-the-counter swaps. These instruments don't require physical delivery. They're bets on the price. And because the volume of paper silver trading dwarfs the volume of physical silver available, the paper market sets the price. COMEX silver futures trade hundreds of millions of ounces of notional silver every single day. The actual physical silver available globally is less than 1 billion ounces. The paper market is leveraged 50 to 1, maybe 100 to 1 over the physical market. This leverage allows price suppression. If a large financial institution wants to cap the price of silver, they can sell massive quantities of paper contracts, flooding the market with sell orders, driving the price down. It doesn't matter that they don't have the physical silver to back those contracts. They're not planning to deliver. They're planning to close the position before delivery. They're trading paper for profit or to hedge other positions. But this system only works as long as most participants accept paper settlement, as long as most futures buyers close their positions for cash instead of demanding physical delivery. The moment a significant percentage of contract holders demand delivery, the system breaks because the metal isn't there. The 50-to-1 leverage means that if just 2% of paper contracts demand physical delivery, the system is insolvent. And that's what's starting to happen. In December, 60% of registered inventory was claimed in 4 days. That's not 2%. That's a run. That's market participants saying, we don't trust paper anymore. Give us metal. And the exchange responded by raising margin requirements. They made it harder to demand delivery because the alternative is admitting they can't deliver. And that admission would destroy the entire futures market instantly. So the price you see on COMEX, $72, is the price of a promise. The price in Shanghai, $78 to $80, is the price of reality. And the gap between those two prices is the market pricing in the probability that COMEX eventually defaults. Every day that gap persists, more metal flows east. Every day the backwardation deepens, more holders of physical silver refuse to sell. They're waiting for the moment when the paper market snaps and the real price emerges. Now, let's talk about what happens when Western vaults hit zero. Because at current drain rates, that's 30 to 45 days away. When COMEX registered inventory hits zero, when London free float is exhausted, when there's no more deliverable silver in Western vaults, the system faces a binary choice: default or revalue. Default means the exchange invokes force majeure. They tell futures holders, we can't deliver the metal, here's cash at the paper price. But that creates instant catastrophe. Every industrial buyer who was relying on COMEX delivery to secure supply is now scrambling on the physical market. Spot demand spikes, premiums explode. The few ounces available trade at $150, $200, who knows, and the COMEX futures market collapses. Because why would anyone trade a contract that can't be fulfilled? Liquidity disappears, the exchange becomes irrelevant, and price discovery moves entirely to Shanghai. Revalue means the exchange admits the paper price was wrong and resets to physical reality. They suspend trading, reassess inventory, and reopen at a significantly higher price. Maybe $100, maybe $150, whatever level clears the backlog of delivery requests against available supply. This protects the exchange's credibility because they're acknowledging the problem and adjusting. But it destroys anyone who was short silver. Banks, hedge funds, anyone betting on lower prices, they get obliterated. Margin calls cascade. Liquidations trigger more liquidations. Financial contagion. Both outcomes are catastrophic. But one protects the system at the expense of certain participants. The other protects participants at the expense of the system. History suggests exchanges choose to protect themselves. They'll change the rules, suspend trading, restrict delivery, whatever it takes to avoid admitting insolvency. But that creates a different problem. It destroys trust. And once trust is gone, the paper market becomes worthless regardless of the price it quotes. So here's the timeline as it stands. We're in January 2026. COMEX registered inventory is approximately 82 million ounces after the December drain. London free float is estimated at 50 to 100 million ounces. Shanghai is at decade lows, 623 tons. At a drain rate of 1 million ounces per day from Western vaults, we have 130 to 180 days of supply. But the drain rate is accelerating. December's 4-day evacuation suggests panic phases can consume 10 million ounces per day. If another panic phase hits, Western vaults empty in 2 to 3 weeks. The trigger could be anything. A major industrial buyer publicly stating they can't secure supply. A financial institution defaulting on a large silver delivery obligation. An exchange announcing force majeure. Or simply the slow, steady drain continuing until one morning, the registered inventory report shows zero. And at that point, the market breaks. Paper and physical prices diverge completely. COMEX trades at $80, but physical silver, if you can find it, trades at $200. The system bifurcates into paper reality and physical reality. And physical reality wins. Now let's address what you should understand about this situation. This is not a prediction of doom. This is an observation of mechanics. The vaults are being drained. The data is public. COMEX reports registered inventory daily. LBMA reports vault holdings monthly. Shanghai reports inventory weekly. None of this is hidden. The 70% decline since 2020 is documented. The December drain of 47.6 million ounces in 4 days is documented. The backwardation, the premiums, the Shanghai price, all documented. The 30 to 45 day supply estimate is math. Industrial demand divided by available inventory equals time until exhaustion. You can argue about the exact number. Maybe it's 60 days, maybe it's 20, but the direction is undeniable. The supply is shrinking, the demand is growing, and the paper market is pretending everything is fine while physical market participants are evacuating. Understanding this doesn't require predicting the future. It requires recognizing patterns. Every physical commodity that's ever experienced a supply squeeze follows the same path. Inventory drawdowns, backwardation, physical premiums, delivery defaults, price revaluation. We've seen it in nickel, palladium, rhodium, and other metals. Silver is following the exact same script. The only question is timing. And based on current drain rates, the timing is measured in weeks to months, not years. This is also not financial advice. This is education. The goal is pattern recognition. Understanding how supply and demand mechanics work when paper markets are over-leveraged relative to physical availability. Whether you own silver, whether you're considering buying silver, whether you're simply curious about commodity markets, understanding this dynamic helps you interpret what's happening in real time. Because the data is there. The drain is visible. The countdown is happening. And the financial system is about to discover that when you promise delivery of something you don't have, eventually someone demands you deliver. And when you can't, the promise becomes worthless. The vaults are drained. The inventory is disappearing. The Western silver market has between 30 and 45 days of accessible supply at current consumption rates. This isn't coming. It's here. The December drain proved the system is fragile. The backwardation proves physical demand exceeds supply. The Shanghai premium proves the paper price is disconnected from reality. And the January 1st Chinese export restrictions prove the metal that leaves the West isn't coming back. So what's the takeaway? Recognize that scarcity is real. Recognize that paper markets can misrepresent physical markets for extended periods, but not forever. Recognize that when physical supply disappears, price becomes the only mechanism to ration demand. And recognize that we're watching this unfold right now in real time with public data, not in theory. The countdown has begun. Western vaults are being drained. Industrial demand isn't pausing. Financial demand is accelerating. And the system that promised infinite paper supply backed by finite physical metal is about to learn the oldest lesson in commodity markets. You cannot deliver what you do not have. And when the promise breaks, the price doesn't adjust gradually, it gaps, violently, instantly, irreversibly. The question isn't whether this happens. The question is whether you're paying attention while it does. The final number to remember is 30 to 45 days. That's the window at current drain rates before Western accessible silver supply runs out. The data is public, the math is simple, and the countdown is ticking. The silver shortage isn't a theory anymore, it's an observable reality unfolding in vault reports, backwardation spreads, and physical premiums. And once the vaults hit zero, the market discovers the truth. Promises aren't metal, and metal is what matters.